India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Friday morning, and thank God for that. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Morning, guys.
Hi, good morning, Prashant. Good morning, Nigel. Morning. A Friday morning, and looks like it's going to be a good one, given not just, it's a bounce back across the global markets, but Neeraj Chopra clinching that silver medal as well. So
well, and the hockey team clinching the bronze.
Yes,
so good going out there. We have added to our tally overnight, champion stuff overnight. So Indians have done well at the Olympics, and hopefully the markets take a cue as well.
Yes.
But, that hockey medal for me was very, very special. Shrijesh, that was his final game that he played for India. The custodian has been standing in the goal for the last many, many years. Took India almost to the finals, and a bronze medal is what we take home. So champion stuff. Thrilled about it.
Absolutely. And, I hope we can continue with the good vibes through the course of the day. Really some jubilant pictures there on your screen. So they're just showing the elation of the team there worked as a unit and got the bronze medal home. Neeraj Chopra, of course, I was thinking I would have gone for gold, but silver is...
Yeah.
but that's gold standard, right? He's won so many medals over the last so many years, and to maintain that kind of physicality over 2 Olympic cycles, it's just quite incredible. Well, as I said, let's hope that we have the market which gives us the same kind of vibes, positive, up and up vibes, because you've got global cues which are positive. I'm going to start there. So we have a decently nice rebound on US markets. The S&P was up about 2% plus, NASDAQ 2.8%, that's about almost 3% gains. The Russell 2000 was up about 2.33% higher. So this is pretty good stuff coming through, and it, you got one more session later today out of the US. I just hope that this is, we kind of end this week in a positive note, because it's been so volatile and so tough. Now, the market rallied in the US after lower weekly initial jobless claims. And, we were highlighting this yesterday that it's a weekly number. Usually we don't even pay too much attention to it. But it became very important, because of the growth scare. And sure enough, the jobless claims came in lower than expectations. And they came in at about 233 versus 250. This is for the week ended 3rd of August. Remember, the initial jobless claims, and the reason why this is important at the margin is because it's a good leading indicator of a recession going back the last 15 years. And it remains at historically low levels. Lots of people are pointing out that the 4-week moving average of the initial claims is at the highest for this year. It is the highest at the highest for this year, but compared to history, it's still at low levels. It may be higher, but over a longer period of time, it is lower. Now, you also had one more headline. I just wanted to mention this. You must have heard us talk about the SARM rule, right? Which is that, unemployment rate, if it rises by more than 0.5% over, the previous 6 months, then you are in a recession. Guess what? Claudia Sahm, who is a Fed economist, she essentially argued in a piece that the US is not in a recession. And she said that her rule was meant to be broken. One of the reasons for why this rule is not working right now, according to her, is the fact that there has been so much immigration into the US. So unemployment rates, you've got to account for all of that when you look at this nearly 0.5% increase that it showed at the end of the jobs data that is last Friday. So that's another point which the market took note of. Apart from that, just market indicators, the 2-year Treasury yield is back above 4%, slightly so. The 10-year Treasury yield is at about 3.99%, just under 4%. So there was about a 5 basis point lift there on the 10-year, which basically gets us to the market levels here. Now, yesterday was disappointing. Remember, day before yesterday, which is Wednesday, the Nifty saw a 300-point rally. Yesterday, we gave back 200 points. So, we've got our work cut out for us. At the day's high yesterday, the Nifty was within 10 points of the lower end of the gap area, a level we put out yesterday morning as well. So the high was 24,340. The lower end of the gap area is 24,350. And that gap essentially is the immediate near-term important resistance zone. So you got to cross and get past this 24,350 to 24,686 levels one by one. Bank Nifty, and then of course on the downside, the swing low becomes important. 23,893 is that number, which was the recent swing low. Bank Nifty outperformed the Nifty. It closed in the green on a day when the Nifty was down 200, but it ended absolutely flat. So there was no help from the Nifty Bank because everything else did so poorly. On the way up, resistance again here is this lower gap area, which is 50,747 for the Bank Nifty. And above that, you're looking at the 40-day exponential moving average, which is 51,085. Supports for the Nifty Bank come in at the 50% retracement, 49,717. And then the swing low, which is 49,659. I mean, you've got to take these markets day by day. GIFT Nifty will come up on your screen. I looked at, F&O positioning, etc. as well. FIs are long, but very small longs. I mean, it's on the client side as well, not very much. Positioning in that sense is kind of clean. From an F&O perspective, index futures perspective, the GIFT Nifty indicating a 250-point higher start. It'll be good to kind of close with those gains, if not more, by the end of this week. Sonia.
Oh, absolutely. A green on the screen, right? I mean, it's almost as if we've left the sell-off behind, especially Wall Street and what we've seen over there. So the GIFT Nifty is suggesting a big up move this morning. 250-point up move. There was a strong bounce back in global markets. As we've been telling you, the Dow was up 680 points. The S&P 500 saw its best day since 2022. This is after the jobless claims data came through. Nasdaq pretty much led the rebound, actually. It was almost a 500-point rally over there. And the focus could be on tech stocks back home as well. So a buy on dips is something that has worked and will work today as well. In terms of individual stocks, right, I just want to talk about some of them. You have Eicher Motors that came in with a decent set of numbers post-market hours. So perhaps we can see that stock move well in trade this morning. You've had ONGC, which has been topping the charts lately. Morgan Stanley, in fact, raised their target price on ONGC to 430 from 302 earlier. That's a big upside to the current market price. Biocon, actually, numbers were on the weaker side, so just keep an eye out on that. And there's the Ola Electric listing today, so we'll watch that one. It's the first electric two-wheeler to list on Dalal Street, so it's a pretty big one at that. And, the first OEM after a very long time listing on Dalal Street, so this is going to assume importance for sure. But for now, the GIFT Nifty is suggesting a very strong start.
Well, Prashant, the point that you made with regard to the US jobs report, normally we just look at the first Friday of the month and say that non-farm payrolls data is important. Suddenly now we have to look at these other data points as well. So it's become a little bit more exciting, given the fears of recession. So we'll have to keep an eye out on that. But as we know, the GIFT Nifty is suggesting a big gap up. But the start is important, but where we close is going to be even more important. And can we have a good close to the week? That's going to be the important factor that we'll be tracking today. Well, yesterday, why was it weak? One of the factors was that the net institutional number was negative. It was close to around 2,000 crores, which is the highest we have seen all the way since the second week of June. So that was the problem pocket. Or we can take 500 to around 1,000 crores of a negative sell number. But when it goes to 2,000 crores, that's what's putting pressure on the markets. In yesterday's trading session, I was tracking a live indicator, which is the premium on the Nifty futures. It came down to around 28 points. You thought maybe there are shorts in the system, but actually there was more amount of unwinding that we saw on the Nifty open interest as well as the Nifty Bank open interest. But what do the FIs do? Well, the long positioning has come down by 90%. Yes, I've not made a mistake on that. It's come down from around 1.5 lakh contracts to around 15,000 contracts in a matter of 5 sessions. So that's the kind of reduction that we've seen. When you get some shorts in the system, it helps that bounce. So I like this screen actually. What about the client positioning? Well, they were net short with close to around 50,000 contracts on the short side. Well, in fact, that's turned around as well. So the client's short positioning from around 50,000 net short contracts, that's moved to around 51,000 net long contracts. So that's an interesting data point as well. Well, moving to the Nifty levels then, let's pull up the options data. The 24,200 call, well, that saw a fair bit of open interest build up in yesterday's trading session. 24 lakh shares getting added, premium at around 155 rupees. So if you go out there and you add 150 to that 24,200 mark, you'll get the resistance zone, which comes in at around 24,350. And the last few sessions, if you look at it, this has been the congestion zone all through the week. We have gone closer to around that level of around 24,350, and we've seen a bit of a U-turn as this data point is telling you. So that's the resistance zone. We start off in the green. You want to end closer or maybe beyond that level. Important to track. Well, let's move to the Nifty Bank. Yesterday, we said it was a weak trading session, right? But the Nifty Bank ended more or less flattish because HDFC Bank is getting into the big week, the MSCI Q that comes in next week. And that stock has been rock solid, defending the 20 DMA as well. And that part of the market could hold one end up because of HDFC Bank. But since global Qs are positive, you have high beta that's doing quite well, risky assets as well doing well. I'll keep an eye out on the metal index. Maybe stocks like Vedanta could do well because there's a bit of a pop overnight. And global facing themes basically, IT as well as metals, both of them have got clobbered. If things are stabilizing, I'll keep an eye out on both these two for today's trading session. Start in the green. Let's see if we build on from there.
Okay, 250 points in the green for the market. So that's what the GIFT Nifty is suggesting. But before we get straight to individual stocks, let's also get you some money market views and what you can expect on the rupee. Lakshmanan B of Federal Bank says that the Indian rupee hit an all-time low due to continued unwinding of carry trades and dollar demand from local importers. The dollar index recovered from a 5-month low on the back of strong resumption of selling pressure in the yen and weaker US jobless data. The market now awaits the CPI data in the following week. And for the coming sessions, he expects the dollar INR to trade in a range of 83.70 to 84.15 to the dollar.
Okay, well, we've got some news coming in on bonds as well. So Lakshmanan weighs in there. He says government bond yields traded lower, tracking a fall in US Treasuries to a year-low level after weak economic data bolstered bets of a rate cut cycle in the US. The RBI MPC policy was in line with expectations with no change in rates or stance. The tone of the policy remains cautious with uncertainty on food inflation. In the coming sessions, the Indian 10-year benchmark bond yield could trade, he says, between 6.8 to 6.95%.
Okay, let's step into a quick break on that note. On the other side, our list of top 10 stocks is lined up, so don't go anywhere.
Okay, welcome back. We have Cameron Brandt with us now. He's Director of Research at EPFR Global, tracks flows very closely. Cameron, good morning. Seeing you after a while here on the program, so good to have you. Prashant this side. So it's all about flows. The only thing is it is yen flows, not dollar flows. There is a report which suggests that 75% of the unwind of the yen carry trade perhaps could be behind us. I don't know if there is... I was struggling to get a number to it in terms of how large the carry... I heard someone say $2 trillion. There was another report which said it could be $4 trillion. But what does it mean when you say unwind of the yen carry trade is complete? Are we talking about yen shorts being unwound? And how do you track it? Your sense. Go on.
Well, we track it at a pretty high level, which is watching which asset classes are getting hit and which aren't. We're certainly seeing money flow back into Japan. Japan equity funds had a pretty healthy inflow during the past week. Flows into Japan bond funds were also a multi-week high. So certainly the repatriation process is underway. It's a little hard to sort of get a fix this quickly, partly because in some cases, since the unwinding of the carry trade has forced investors to sell, there's plenty of money around trying to jump on those more attractive assets that are available at a decent price. So the main risk reduction we've seen after all this ruction's actually been on the fixed income side. We've seen pretty significant outflows from high yield bond funds and leveraged loan funds and a move away from emerging markets debt. Though once again, and mirroring what we've seen for a while, on the equity side, both India and China seem to be getting a pass.
Okay, so can you elaborate a little bit on that, Cameron? For the Indian markets, how are flows expected to be? Because the going has been really good so far. Do you think we can build on to our gains?
Well, certainly the people are beginning to focus on the addition to key indexes. And sentiment overall towards the major emerging Asian markets has been very good. We've seen that more strongly reflected on the equity side, but it seems to be spilling over into the fixed income side as well. Both India and China bond funds had multi-week highs in terms of inflows this past week. And certainly the commentary surrounding Indian debt at the moment is that, unless your country's central bank gets a little spooked by overly strong inflows from foreign investors, that those foreign investors will start to come.
Hi, Cameron. Good morning. Good to see you in. Give us your sense about other asset classes as well. How have flows been to gold? That asset class actually has been holding steady. And maybe, in fact, it's under ownership of retail participation, so to call it. So that could do well from here. How are you seeing flows? And maybe even if you could give us a sense on cryptos, Bitcoin.
So gold continues to be curiously unloved in an environment where you would expect much more interest in building up a bit of exposure. Another 600 million out of, 350 million, I think, out of physical gold funds this week. Flows to crypto funds have certainly faltered, and quite how they will react to events, I'm not sure. I don't see them as an asset class that figured largely in the carry trade, but it is all new territory there. But no, certainly the usual suspects are still seeing fresh money. U.S. equity and bond funds had solid, if not spectacular, inflows. Money continues to pour into technology sector funds. How long that will run, given the much more skeptical background noise, is an open question. But for the moment, any dips in the market are definitely being treated as opportunities to come in at a slightly better price.
Okay, we'll leave it at that. Thanks a lot for joining in, and have a great weekend. Cameron, thanks for being with us on the channel. Well, let's do one thing. Let us talk about individual stocks now that you need to watch out for in our top 10 list of stocks. First up we have on our list is Eicher Motors. Decent set of numbers coming through. A revenue growth of 10.5% is what the company has clocked in at 4,393 crores. The EBITDA has gone up 14.5%. The margins have actually improved 100 basis points to about 26.5%, and the net profits are up almost 20%, coming in at 1,100 crores. Goldman Sachs put out a report where they have a buy, and they have actually raised their 12-month target price by 4% to 5,600 on the stock, which implies a 22% upside to the current market price. And they talk about how the upcoming new Classic represents an upside or optionality, and they are quite bullish on the stock. So I'm going with green on Eicher Motors this morning. But Vamakshi is joining in to give us a quick word on ABB and how you should approach that one. Vamakshi, morning.
Well, good morning. I'm going with the green for ABB, and that is because the company reported a modest beat as compared to expectations. Revenue came in at 2,831 crores. This is an uptick of almost 13% on a YOY basis, but it has missed pole by almost 8%. When we look at the segment-wise revenue, robotics and discrete automation declined by almost 31%, but the revenue growth is largely being driven by process automation, electrification, and motion. All of these segments saw a double-digit uptick this time around. EBITDA margin expanded by 526 basis points and came in 225 basis points higher as compared to our expectations. Largely, this is being driven by positive price movement, cost optimization, steady material cost as well. Robotics and discrete automation, motion, electrification, and process automation, all of these counters witness an uptick in their EBIT margins as well. Net profit resultantly saw an uptick of almost 50%, coming in at 444 crores. This This is nearly 3% higher as compared to expectations. Order inflow, however, was a bit subdued, saw a downtick of 5%, but the order backlog was up nearly 7%. Again, muted growth out here as well. The company also announced its a capacity expansion plan. They will be expanding its operation in the process automation and electrification business and will be making investments up to 85 crores. Overall, given the modest beat on its numbers, going with the green for ABB. Watch out for the commentary on the con call, which is scheduled at 11 a.m. today.
All right, green on that one as well. Thanks, Pamakshi, for that. Well, let's hop across to Ekta. She's here to tell us about Biocon. Morning, Ekta.
Thanks for that. Well, Biocon, I expect the stock to be in the red based on what they've reported. But it's important to note that their conference call is at 9 a.m. So the commentary might, in fact, change the course of the stock. Now, in terms of the revenue, I expect it to be flat. It was flat on a year-on-year basis. The street was anticipating a double-digit growth. Margins came in at 18.1% versus 21% versus estimates of around 21-22%. And the profit 659 crores because there was that Eris Life deal that they accounted for in this quarter. Biosimilars revenue was lower or flattish, you'd have to say, but on a like-to-like basis, it was up 11-odd%. Research services, Syngene, we know, was sluggish this quarter. Generics was down 6% as well. Other income was stronger because of the Eris Life deal. Company says they anticipate a stronger growth in the second half. I'll wait by for the conference call takeaways to get a full assessment on how the stock could perform today.
All right, Ekta, thank you very much for that. But there's more, so hang in there. We're coming back to you. LIC reported numbers. The country's largest life insurer, Yash, is here with details on how the company did. Yash, morning.
Well, Prashant, if I just had to go by what the company's reported in the first quarter, then I would certainly go with red, and that's because the company's missed what the street was baking in terms of numbers on various parameters. If I have to take you through the numbers, the new business premium was the only number where LIC reported its numbers ahead of the street estimates, but total annualized premium equivalent, it missed street estimates. Retail annualized premium equivalent, it missed street estimates. Value of new business was a miss, as well as margins were a miss. In terms of absolute numbers, total APE was up 21%, retail APE was up 13%. Value of new business was up 24%, and finally, value of new business margins was up by 20 basis points. As I said, these were the negatives in terms of what the company reported in the first quarter, and hence I'm going with red. But what will be positive is the management's commentary on saying that they stick to FY25 guidance of AP being somewhere about 15%, margins being 19 to 20%. The stock has had a significant run-up in the last 1 year, in the last 6 months. Still remains to be one of the cheapest in the sector, trading at about 0.75, 0.8 times FY25 price to embedded value.
Okay, all right. Thanks a lot for that, Yash, and hope you had a good birthday evening yesterday, maybe the remainder of the celebrations over the weekend. Well, that said, let's hop across to Manglam. Manglam, how was Concor?
Well, no surprises, neither positive nor negative from Container Corp. So if you look at the revenues, 9.5% jump out there. The company had reported its volume growth at around 6%, so not much deviation is reported from there as well. 11.5% jump in the EBITDA, margins largely contained around that 21% mark. The net profit grew by about 6%, impacted by some bit of profit, rather depreciation as well. You have the Exim business, which saw margins of around 20% with a 7% revenue growth. Domestic business showed a 13% revenue growth. Out there, the EBIT actually expanded by 40%, causing a bit of a margin expansion out there as well. No negative surprises coming in from the land license fee as well. For this quarter, it's pegged at around 106 crores. This compares with around 130 crores the same time last quarter. And we already had the volume update, so not much deviation from there either. So going with mild green on Container Corp on account of the mood of the market and no negative surprises coming in.
Okay, thanks a lot for that. Well, Sonal is with us to talk about Oil India and why you should be watching that one. Sonal, good morning.
Good morning, Sonia. Well, Oil India reported numbers. On a sequential basis, the revenues were up 1.5%. If you look at the EBITDA, that was up 6% as well. Margins came in at 42.2% versus 40.6%. But profits this time were down 28% sequentially. That is largely because of other income going down. Other income declined 80% to come in at 162 crore rupees versus 833 crore rupees. The conference call is at 11 a.m. today. We'll get more details about production, sales, volumes, etc. But do remember, the stock is up already 146% on a year-to-date basis and trades at 9.5 times FY26 EPS. The performance is good, but it is not as strong as ONGC, which is trading at around 4.9 times FY26 EPS. So yes, the stock could see some green, but it could see some red afterwards. A lot depends on the commentary coming in from the management as well.
Got that. Thanks for that, Sonal. Well, let's focus on SAIL then, and I'm going with red, and let me explain that to you. On the top line, it was a little bit better. The EBITDA number was bang in line, and the profitability was hit by a one-off. Let's run you through those numbers. The sales volume number were up by close to around 3%. That was on expected lines. But SAIL has grown less than what the market as well as its peers, so that's telling you it's lost market share. Then how did the top line beat expectations? Well, they're focused on their product mix. Longs as a percentage of the total mix, that's at around 37%, which is higher than peers besides JSPL. And also value-added products is more than 55%. So because of the better product mix, realizations were higher than what the street worked with, and that explains why the top line was a beat. The operational performance was pretty much in line with what we were working with. The reason I'm going with red is the debt number of SAIL has moved up. On a sequential basis, it's moved up by close to around 5,000 crores because of expanded working capital as well as because of the capex that they are incurring. And that chart tells you the picture. For the last few years, we've been talking about SAIL. At some point of time, they'll start deleveraging their balance sheet. Well, the debt number today is the same as it was on March 2021. So that's a problem pocket for me. And as we know, steel prices are lower, as well as, when iron ore prices fall, some of the integrated players like SAIL, they lose their advantage. So going with the red out there, what saves them is that the global markets are looking good this morning. And also the markets appears are net short on this going into the event. So let's see how that goes.
Okay, well, MCX is also something we're looking at this morning. Vamakshi is here to tell us why. Vamakshi, over to you.
Well, MCX is expected to open higher today, and that is because SEBI has finally approved the appointment of Praveena Rai as the MD and CEO of MCX. Now, of course, her appointment is subject to acceptance of the offer made to her as well as the approval from shareholders. Keep in mind that she is a banker with nearly 25 years of experience, and in her last role, she is the Chief Operating Officer at National Payments Council of India, that is MPCI. Keep in mind that the CEO's position at MCX was vacant since PS Reddy stepped down on May 9th, and with this nod coming in from SEBI, it bodes well for the counter. The overhang on the counter seems to have gone away as the street was expecting this for a very long time. Overall, going with the green for MCX on account of this.
At the margin, there was also news which I think Reuters, the Newswire, reported that BSE is essentially looking at launching, derivative contracts, gold derivative contracts, and I think on silver as well. But we'll need to confirm this with the BSE. There was a news report coming in from Reuters, so maybe more competition. So we'll have to see. But point taken, Vamakshi, thanks very much. Person at the top after some time at MCX. Well, let's talk about Cochin Shipyard. Astral reported numbers. Upasana is here with details. Upasana.
Thanks so much for that. First up, let me start with Cochin Shipyard. Company reported strong set of numbers. Revenue stood at 771 crore with an uptick of 62% on a YoY basis, and EBITDA margins also expanded from 17% to 23%, mainly led by ship repair segment. PAT stood at 174 crores with an uptick of 76% on a YoY basis. Now coming to company's key segments, shipbuilding recorded a strong revenue growth of 62% on a YoY basis, and margins stood at 17.5% versus 19.3%. Ship repair also recorded a strong revenue growth of 63% on a YoY basis, and margins here expanded sharply from 24% to as high as 43%. Next up is Astral. The company Q1 FY25 numbers slightly missed the street estimates. Revenue saw an uptick of 8% on a YoY basis. EBITDA saw an uptick of 6% on a YoY basis, and EBITDA margins saw a downtick of 20 basis points at 15.5%, while company's PAT stood at 119 crores, which was stable on a YoY basis.
Okay, thanks a lot, Upasana, for that. Well, here's a quick recap of our top stocks. Stocks with positive news flow. There's Eicher Motors, ABB, Concor, Oil India, MCX, Cochin Shipyard and Astral. While stocks with negative news flow, there's Biocon, LIC and SAIL. Let's take a short break. On the other side of the break, Siddharth Khenka of Motilal Oswal Financial Services will join in for some fundamental stock analysis. Stay tuned. Welcome back. We're getting ready for a market that is all set to open well in the green. But there's also another big story today, which is in the primary markets. The much-awaited Ola Electric Mobility shares will list on the bourses today. The company received over 4 times the number of bids for the shares of offer. Earlier this week, we spoke to the chairman and managing director, Bhavish Agarwal, asked him about the EV maker's path to profitability. Listen in.
Just wait for our Q1 results, which will be out soon after the listing on 9th August, and you will get to see the financials then. But thematically, if I tell you, if you look at our business in FY24 over FY23, we grew revenue 90%. And our revenue in FY24 ended up at around 5,300 crores. So this shows you the kind of improvement the financials already in the public domain showcase. And this is because, in manufacturing businesses, there are two themes I want to leave with your viewers here. In manufacturing businesses, as you grow scale, and we've seen very significant volume and revenue growth, your cost structure, the factory investments, etc., don't scale linearly with it. In the EV era, the cell is the heart of the vehicle. And hence, 4 years ago, when we began this company, we decided to focus on making our cell in-house. And if you look at the amount of cost contributed by the cell, if a vehicle costs 100 rupees, the cell costs about 30 or 35 out of that. This is like an average across multiple companies. The entire margin that global cell companies make, as well as a 5% duty that cells have when they come into India, all of that money we will save when we start using our own cell in our vehicles. Step by step, all that margin on 30% cost, assume saving 20-30% margin, all of that will eventually come into our books.
Okay, so that is Bhavish Agarwal, a big listing coming up today. Siddharth Khemka of Motilal Oswal is with us. Siddharth, people are on the fence with this one. What is your expectation post-listing? Given that the overall electric two-wheeler sector is undergoing a bit of a slowdown and Ola Electric is sitting on large losses as well, what's the way forward for this one?
Good morning, Sonia. Yes, so even we are sitting on the fence right now. We don't have a view on the IPO. So we will be waiting for the results that Bhavish just talked about. So definitely it's an upcoming sector, but and we have seen the EV penetration in two-wheelers to be the highest in India so far. So growth in this sector will come by. But as you rightly said, the company is right now loss-making, and they intend to come into even lower price segments where we believe the losses could even increase in the near term. So it's definitely a wait and watch, and the path to profitability, as we have seen in some of the other past new age companies that got listed, that could drive the stock price in future.
All right. Hi, Sid. Morning. Good to see you. And let's talk about a couple of listed companies then. LIC, plenty of retail interest over there because the IPO was disappointing. Post that, the stock nearly halved. How do you read the numbers? Valuations are a support, but your pick from the insurance space.
Yeah, Nigel, good morning. So yes, I think LIC, very good numbers last few quarters. For this quarter, they reported a net premium income of 7,500 crores, the growth of 16%. The new business AP, which grew 9%. And if you look, VNB margins for the quarter stood at almost 14%, 13.9%. And if you look for the last couple of quarters, we have seen that the company has come out with good numbers. We believe LIC has levers in place to maintain its industry-leading position and ramp up growth in the profitable segment, which is mainly your protection, non-par, as well as the savings annuity products. However, given the size, it will take time and requires a lot of superior and well-thought execution. So we expect it to give about 11-12% AP growth, and which should lead to a VNB CAGR of 18%. Valuations definitely supportive. So we have a positive view on LIC and a buy rating. We'll come out with a target price. But within the insurance space, SBI Life is something that we like. Company came out with a decent performance in Q1. AP for SBI Life grew 20%, whereas the VNB grew about 11.5%. Margins have been pretty strong. Again, the expectation is that the AP and VNB would remain pretty strong going forward, and SBI continues to maintain its cost leadership. So we are expecting an 18% CAGR both in AP as well as VNB for SBI Life, which is our preferred pick, with a target price of 1,900.
Got it. All right, Sid. Request you to stay with us. Let's invite our first management, Galaxy Surfactants. They reported actually an improved set of numbers. To understand about the way ahead, we're joined by Mr. Natarajan, the MD of the company. Hi, Mr. Natarajan. Good morning, and thanks a lot for speaking to us here on CNBC TV18. Let's get a couple of those basic numbers out of the way. The volume growth has been impressive in the first quarter at around 8%. Earlier, you were guiding for around 6 to 8%. Do you want to guide now for a upper end of the range, or do you want to revise it? And also the EBITDA per ton, what was it in the past quarter? And do you want to stick to that band of around 20,500 to around 21,000?
Yeah, good morning. Thank you for having me on the show. With regard to the volume growth, I think the team has done a fantastic job given the sort of headwinds that we have on the supply side. But then I'd like to stick to the volume growth of 6 to 8% once we look for 2 more quarters to see as to whether I need to guide it upwards. With regard to the EBITDA per metric ton, we revised the guidance just last quarter to 20,500 to 21,500. And I'm pretty happy that we have come closer to the lower end of the guided and increased range. We do see the coming quarters with the premium specialty segment picking up in the developed markets. We could touch the higher end of the band of the EBITDA per metric ton.
Is 21,500.
Yeah, that's the higher end of the EBITDA guidance that we have given.
You were talking about how the specialty business, which is low volume but high margin, I mean, destocking in the US is probably coming to an end. Is that, could you shed more light? Is it actually happening?
Oh, yeah, it has. So I think mercifully the destocking has bottomed out. And then we do see orders coming back. But yes, there are certain projects in pipeline that were put on hold for the last 1 year. They have started getting revived with regard to the premium specialties, and we do expect that to gain momentum in the coming 2 quarters.
In the export markets, is it more of the specialty product sales or performance products? And what would you see as the growth driver, specifically in the export region?
Yes, in the export market, I think we need to look at it into 2 parts. One is what we do in the Africa, Middle East, Turkey is majorly driven by performance products. Whereas if you look at the markets other than AMED and the rest of the world, that's more driven by the specialty ingredients.
Okay, so what about the freight situation right now in the export market? What's the latest there?
Oh yeah, the freight situation is bad. I think freight rates have more than doubled in most of the sectors. More than the rate increases, I think what's a challenge is in terms of getting space to get our products loaded, and also in terms of the enhanced transit time. So both incoming and outgoing situation in terms of freight has been impacted. But yes, we have started adjusting to the new normal, and we do hope that in at least by October things start settling down, and we at least have a proper space available on the ships to be able to serve our customers well.
All right, Mr. Natarajan, final question before we let you go. You're currently doing around 1,000 crores per quarter. What is the utilization levels that you're going at? And also, what is the capex plan that you've lined up for FY25, FY26? What should the asset turn on that be?
Yeah, so we are at about 70% capacity utilization. And then we typically have about 150 crores of capex per annum. And the asset turns typically would be in the zone of about 2.5 times.
Okay, all right. Thanks a lot, Mr. Natarajan, for joining in. Wishing you a good day ahead and a good quarter. We look forward to chatting up with you in the time to come. For the last 1 month or so, the stock is a little bit lower, but these numbers look pretty good. And in fact, the management commentary as well, pretty stable for times ahead. Well, let's go back to Sid Khemka then. Sid, what's your take on a couple of these companies? If you have a view on Galaxy Surfactants or a couple of other names, PI Industries and the likes.
Yeah, so we do have coverage on Galaxy. The results were better than our expectation, mainly on back of the lower operating cost and raw material cost, which led to EBITDA being higher. PAT also came in much higher than our expectation. So overall, if you look at in terms of Galaxy, we believe that the outlook for the business remains positive, and the structural story is impact. There has been improvement in the accessibility for the products due to the quick commerce and the headroom for growth in the personal care segment. So overall, what we are seeing that with the continued effort and focus on R&D and the increased share of wallet from its existing customers, this would be driving the volume growth going forward. And even with raw material prices coming down, OPEX being lower, we expect margins to see gradual recovery, also higher share of premium specialty products to drive volume. So net, what we are liking is valuations are also comfortable for the stock. The stock has come down recently. So we have a positive view, the buy rating and a target price of 3,450, which is a decent upside from current levels. Even if you look at other companies in the specialty chemical space, PI Industries has been doing well after the past few quarters where the overall numbers were kind of weak, but now things are kind of improving. And again, that is a space where they have consistently done well in the CMS space as well specifically. So that is again a stock that we like in the agrochemical space. And again, we have a positive view on buy rating on PI Industries.
Okay, got that. Just a quick word, Sid, if you track Lemon Tree, stock was down 10% yesterday. I think seasonally it's a bit of a weaker quarter occupancy-wise for hotels. I mean, EIH was a case in point as well. Do you have a view?
Yes. So if you look at Lemon Tree, yes, results were not that good for Lemon Tree. Seasonally a weak quarter. And if you look at overall, the revenue was quite good for the quarter, 21% growth, led by good growth in ARR and opening of newer property in Mumbai. However, what was weak was EBITDA margins came under pressure primarily due to increase in renovation and business expenses. The company is renovating its entire inventory by FY26, and hence while in the interim there could be margin pressure, we believe that will lead to improvement in ARR by FY26. And hence, while the near-term pressure would continue, the overall hospitality space is doing well, as seen by the volume growth, the revenue growth for Lemon Tree. So we continue to remain buy. From a long-term perspective, we have a target of 170. But as I said, near term, because of the margins, the stock could remain under pressure.
Okay, well, Siddharth, I have many more questions for you, specifically on some of these auto names like, Bharat Forge and Eicher Motors, but more on that coming up in a bit. For now, let's take a break. When we come back, we'll get you some thoughts on the technicals of the market. Mitesh Thakkar and Shrikant Chauhan of Kotak Securities will be joining in.
Welcome back. There's 10 minutes to go for the pre-open session. Let's get in our technical experts for quick calls on what they'd like you to do. The GIFT Nifty implied open is about 250, 260 points higher. Mitesh is with us, and so is Shrikant Chauhan of Kotak Securities. Gentlemen, good morning. Great to have both here. Mitesh, so back up again, 250. It's like a roller coaster. It's just you got to sort of not get stuck at the chopping area. So what would you recommend for viewers on the index at least?
Good morning, Prashant. I think yes, typically corrections do turn choppy, and I think this is a prime example of what we are seeing: a gap down every alternate day and a gap up the other day. So I think today will be a gap up, but the most important thing is that we'll open around that 24,350, 24,400 zone, which is where the gap down starts and which is where the intraday averages are placed. So I think if we don't sustain about 24,400, I think I would still maintain a negative stand and add on to put options positions. The median of the gap is close to about 24,550, 600 zone. So that's where we can go aggressively short on the futures side. But the structure to me still looks negative, despite the fact that today could be a good day in that negative structure. But I think capturing 24,400 on an intraday basis or even a closing basis would be important, because today we also have a weekly close. So let's see if we can sustain about 24,400, or if we get signals during the day that this level will be crossed. But my initial feel is that post the gap up, I think there could be some supply again.
Okay, got that. So Shrikant Chauhan is also with us. Shrikant, Do you think this continues to be a buy on dips market, and what's the best strategy today?
Good morning, Sonia. Good morning, Prashant. Nigel. I think this market is definitely not a buy on dips because we saw a vertical decline in the market. But at the same time, if we see the overall trend of last 4 days, then it was in the range, and it was mainly because of specific uncertainty in the global markets. But today, on the back of specific news flow from the US markets, I'm of the view that we could see some short covering. And in this type of market, we should look for taking some breakout trades in this market. About 24,400, I'm expecting Nifty to move towards 24,650 or 750 sort of levels. And today, I think we should look for taking that bid. So we can keep stop loss at 24,150 for taking any long trade in this market. But yes, as Mitesh said, we need to see that whether the market is crossing 24,400 or not. For the Bank Nifty, it is relatively doing well, but it has hurdle at 50,750. Above that, I'm expecting Bank Nifty to move towards 51,500. So broadly, I think Bank Nifty is also ready to move towards 51,500 or 250 sort of levels.
Okay, got it. Good morning, gentlemen. Good to see you in. Srikanth, you go first. Tell us what are the stocks you're tracking?
Yeah, I would like to go with oil and gas sector because there we are seeing good amount of strength. Most of these stocks are trading above their important supports, and even though there was weakness in the market, most of these stocks managed to survive above their important support areas. ONGC looks good. It is around some 320. It is around 320.25 levels. So from here, the stock can move to the levels of 355 or 360. We can keep stop loss at 310 for the same. And the other stock which we like is LIC, Life Insurance Corporation of India, which is around 1120, 1130. There I'm seeing a very consistent upward rising pattern. Here we are expecting stock to move towards 1250. So it's a buy at current levels with a stop loss close to 1080.
Okay, well, what about your stock? Okay, those are the stock ideas. Mitesh, what about you?
So, despite the fact that I have a negative view, today we'll have some buy calls looking at stocks which yesterday were closer to their support levels from where some reversal can happen. And L&T is one of them. 3520 is a very important support area if you look at the last 2-3 months of price movement, and multiple times the stock has bounced back from there. It's trading around 35, 45, 50 marks. So buy here for targets of 36.15. PEL also, after a good rally corrected in the last few days, is now at important moving averages. So buy here with a stop at 925 for targets of 980. ABB is a buy. ABB, in fact, looks like a stock which has completed its correction. We had a buy call there yesterday as well. Now can be bought with a stop at 78.30 for targets in excess of 8,200. And one sell call, Page Industries, I would want to sell at a slight bounce back. So around 40,750, 800. Sell with a stop at 41,200 for a first target of 40,000 and then maybe below it.
ABB, Page, and what's the first one, Mitesh? Missed that?
L&T.
L&T. Larsen & Toubro. All right. And the target over there?
L&T, I'm looking at a target of 36.1520 to begin with. And then in case the Nifty starts getting past 24,400, good chance that we'll see 36.60 here.
All right, we'll leave it there, gentlemen. Good speaking with both of you, and we speak again at 9:10 for more sort of ideas as the pre-open sort of starts, kicks off, and then we'll have a better sense of where things are opening up. We'll be joined by the management of Gokuldas Exports on the other side, so stay tuned for that conversation. Q1 numbers came through, stock sold off. We're coming back in just a bit.
Well, Sneha Seth is joining in. She's the derivatives analyst at Angel One. Sneha, hi, good morning. How are you feeling about the market now, and what is the strategy for today?
Very good morning, Sonia. If you look at the market, it's been 4 sessions wherein index has been trading in a 500 points range, wherein 23,900 has been acting as a support and 24,400 has been acting as a hurdle. Today's opening would be positive, and any move, any sustainable move, especially above the gap area which we have seen, which is around 24,400, 24,700, then only we should, go ahead and long. Otherwise, I would recommend if any bounce back we are seeing, that should be utilized to exit your longs if you have any. Because looking at the FI's long short ratio, which has declined towards 50, the rising put call, the rising IVs, which is not giving up very comfort to go ahead and long at this point in time. Individual counters, if we talk about, I have one call which is a buy call, that is on ITC. If you look at this counter has been in pressure recently, but it has bounced back from the important support around 20 DEMA. I believe we can see an up move at least towards 509, and so one can go along with a strict stop loss of around 487. Apart from this, I have a sell call on DLF. This counter has been recently under selling pressure. It is trading around 89 EMA. We have seen decent writing in call option along with unwinding in put options. So I believe we may see a correction at least towards 799. So for the target of 799, it's a sell. The stop loss can be maintained around 584.
Okay, thanks a lot for that. Well, Siddharth Khemka is still with us, so let's get a couple of calls in from him. Siddharth, the stock I wanted to ask you about was Bharat Forge, because in this quarter's numbers, the defense vertical has grown very sharply and it's a large contribution now to their overall revenue growth. Would you play the defense theme through some of these stocks like Bharat Forge, or are there, other pure play defense companies that you'd rather pick?
Yeah, so Sonia, if you look at definitely this quarter, defense was the key growth driver, while the other businesses were showing signs of weakness. And so if you look at the overall view, the order book that they have is a mix of artillery guns, vehicles, and consumables. So defense business, we are expecting it to be a key growth driver, and also the strong traction in terms of outsourcing opportunities from China, Europe to India in the industrial segment should be positive for Bharat Forge going forward. Again, it expects its aerospace business to double in the next 3-4 years. So clearly, if you see in terms of the overall numbers, there is a good, strong growth that we are expecting because of the increasing contribution of defense, which should lead to almost 50% CAGR in net profit over the next 2 years. The stock has run up and valuations in line with a lot of other defense companies, pure play defense companies. So to play purely defense, I would still go and buy a Bharat Electronics or a HAL. But if I were to play the overall industrialization along with defense, I would still look at a Bharat Forge.
All right, Sid, thank you very much for that. Good conversation as always, and have a restful, nice Friday and the weekend as well. We'll see you next week. Let's move on to Gokuldas Exports. So first quarter numbers came through, and we'll talk about the numbers in a bit, but let's start, of course, with what's happening in Bangladesh and what the impact could be, implications could be for a company like Gokuldas. We have Siva Ramakrishnan Ganpati, Vice Chairman and Managing Director at Gokuldas Exports, now joining in. Siva, great to have you with us here. Good morning. Prashant this side.
Good morning.
As I said, Q1 in just a bit, but tell us what is the situation, because there's been so much talk about how, with textile mills in Bangladesh coming to a bit of a standstill, maybe temporary, buyers may be looking elsewhere and India stands to benefit. So is that a reasonable assumption to make? Is it actually happening? Tell us.
So we have to look at it from a little longer term perspective. In the short term, all the textile apparel factories have reopened and they've started. Most of them have reached some 90% of their productive capacity levels. So the disruption was there in Bangladesh, but they are coming back out of it pretty quickly. And that's because this industry is pretty critical for Bangladesh's success, and the government and everybody will work towards restoring that industry to its productive levels very quickly there. So the issue is different. The issue is, most of the brands have been worried about the volatility in Bangladesh for quite some time, and that reached a flashpoint a week ago. And one never knows how things will evolve going forward. The only certainty is that there is instability and a lot of uncertainty. Given that scenario, there is a lot of pressure from certain brands to increase their allocation, outside of Bangladesh to regions like India, and that would happen. So it's not that Bangladesh is going to, suddenly sharply drop or anything at this moment, but there will be a more secular trend of looking at alternative locations just to de-risk many of their sourcing from Bangladesh. Commercially, most of the brands would love to source from Bangladesh, given their cost advantage, and especially Europeans, they would like the duty advantage as well. Having said all of that, nobody wants to take all the risks or put too many eggs in one basket. So from that perspective, most of the brands are seriously looking at some bit of diversification, and then they will wait and watch. So that's how I'm seeing this unfold over the near term.
But they were always looking at a bit of diversification, Siva, right? Or is that
they were
incrementally a little bit more now in terms of
that? That is correct. They were particularly in the last 1 year. I've seen a lot of them look at diversifying outside of Bangladesh because people were reading this. And now, this would get a little more fillip because of what has actually happened. The flashpoint has been, reached, or the trigger has happened. So it would result in a little more, concerted, work towards moving things out of Bangladesh. Not a whole lot, but some bit. Even that some bit will be fairly big for us.
All right. Hi, Siva. Good morning, and always good to see you in. And I understand, with some feedback that a lot of top bureaucrats, army veterans, they hold most of those textile hubs over there. So that's why it's critical to get it up and running. So that's about Bangladesh. Let's keep that aside. Let's focus on your company. Growth has been good with a mid-teen growth. For the remainder of this year, what kind of a growth you're looking at? Since you have the inorganic growth as well that will play out. On a consolidated basis, should we stick with high teens, mid to high teens? Will that be a fair assessment? And also margins got pulled back because of the acquired entity. And also you had some, a higher employee cost and a couple of other expenditure. Will margins start improving? Should we see it in double digits by second quarter itself?
So I anticipate margins to improve from second half of this year, especially because we have some acquired entities where, there would be some moving parts. Q2 has been seasonally a weak quarter, not particularly for Gokuldas, but for the industry in general. So some of the acquired entities may still see some softness in Q2 on account of the seasonality when the season changes from fall, winter to spring, summer. But that said, I think from third quarter onwards, there's no looking back. Our growth will continue because we're seeing a fairly strong order book, and all our factories are full going forward. And we anticipate, growth, as you said, in the mid-teens. So that would happen. The critical factor that we are working on is to bump up our margins. We had some one-off issues in Q1 as well. And very marginal residual impact in Q2, but largely we have confined it to Q1, where we lost a lot of production capacity in April and May on account of huge amount of worker absenteeism, etc. But then we've recovered from there subsequently, and we've augmented our workforce also pretty strongly since then. So I see growth happening and margins catching up somewhere in the second half of this year.
So second half, it gets back to double digits?
To double digit levels, absolutely.
11, 12%?
Closer to 11% perhaps, because we still have the acquired entities which may not be as profitable, at the high margins as we are. That would probably take FY26.
All right.
Yeah, FY26, the next financial year.
Siva, just the fundamentals of the business, exports to US, Europe, etc. What is it at? I mean, I think we spent the bulk of the last 6 months, 7 months, whenever we spoke, talking about this destocking coming to an end, etc. Where is it at? I mean, is momentum strong? Is it moderate? Is it expected to pick up?
Good question. Most of the destocking has happened. When I talk to all the brands that we work with, and which is most of the brands in the globe, big brands in the globe, they've all reached a stage where they're buying again. They've reached an optimal inventory levels, and they are back in the market buying. In fact, that's one of the reasons why we are seeing a fairly strong order traction as we speak. Even outerwear brands which were not really buying for more than a year have now started indicating that they have also reached an optimum optimum stocking level. So there is a more secular trend of buyers wanting to, restock as the retail sales in those markets continue to grow. So even if you look at calendar year 2024, the last 6 or 7 months, you'll see that the retail sales is 3% higher than the same period calendar 23. So the end user demand is not seeing any abatement. So there is a need for brands to stock up their inventory, and that's why they're coming and buying. Now, has the global demand supply reached a sort of equilibrium level? I would say no, since most of the brands are still being very cautious before extending themselves. They're also waiting and watching to see how their own economies will play out. But as far as Gokuldas is concerned, we have a fairly strong order traction simply because we have a very diversified customer base. And most of the customers that we have are, touchwood, doing exceedingly well. So they are coming in and sourcing more from us.
All right.
Okay. We'll leave it at that. Thank you so much for joining in. And, have a great, rest of the year, Q2, Q3. We'll, of course, touch base with you again later. For now, it's 9:10, so let's get some calls in. Mitesh is with us. Mitesh, what's the big call at 9:10?
Well, I'll go with the buy on Piramal Enterprises for targets of 980.
Okay, and let's also talk about Eicher Motors because the stock is up 5% right now on the back of a good set of numbers. The revenue growth was 10%. The EBITDA growth was 14.5%. The margins came in higher at 26.5% versus 25.6%. So good improvement in margins, and net profits went up about 20-odd%. Brokerages are largely positive. Goldman Sachs says that Eicher reported a Q1 beat. They raised their 12-month target price on the stock to 5,600. They say there's a 22% upside potential to the stock. The new Gorilla 450 launch that happened has already done 6,500 units of dispatches since the July 17th launch. So they are quite optimistic there. Investec, though, maintains a sell. They say valuations appear a bit rich at 26 times FY26 EPS, and the volume growth is expected to moderate.
Okay, all right, Sonia, thanks for that. So that's Eicher. I'm focusing on Birla Corp. The numbers look quite disappointing. Remember, the stock has corrected from around 1,800 rupees to around 1,400. Nonetheless, these numbers look disappointed. Like on the top line, there was a degrowth of close to around 9%. A couple of factors played out here. Realizations were under pressure. Volumes are more or less flattish. In a growing market that's growing in mid-single digit, you're not growing. That tells you that market share is being lost as well. And in addition to that, realizations were under immense pressure. And the management's commentary as well is that demand is quite subdued, and Q2 as well is likely to be soft. Operating profit did decline by close to around 13%, which tells you that margins did contract from around 12.5% closer to around the 12% mark. One positive is the power and fuel cost has come down because they've been focusing on the renewable power as a percentage of the mix. The profit number as well did get hit. Finance cost, well, it continues to remain elevated. The debt number at around 3,100 crores odd. The jute business, which is a very small part of the business, reported a net loss. So these numbers are disappointing. What supports them is the stock has corrected from the recent peak, and it trades at around $85 per ton on an EV upon EBITDA basis. So EV per ton basis, so that supports it a little bit.
Absolutely, and we'll keep an eye out on these. I mean, the other one, Shree Simmons, has been under pressure as well after reporting numbers a few days back, and there was, of course, a wide miss there. What do we have? First rates should come up in the next couple of seconds, and we'll be looking at it. But I think we can squeeze in Container Corporation as well. Mangalam is here to shine the spotlight on that one. Mangalam.
Well, no surprises coming in from Container Corp in the first quarter. No negative surprises, no further positive surprises either. But the stock has corrected about 15-16% from the highs, and the market mood is good. So hence, we're seeing a mild green tick at the pre-open on Container Corp. 9.5% revenue growth on the back of 6% volume growth. Remember, the volume data was revealed by the company already. The margins are stable at around that 21% mark. And we've had the Exim business, which showed a revenue growth of 7.3% despite a volume growth of just 3.3%, telling you that there have been improvements in realizations out there. The domestic business showed a revenue growth of 13% on a volume growth of 15%. But on there, the margins have improved from 5.3% to 6.6%. That's a positive. And again, no negative surprises coming in from the land license fee as well. 106 crores. This compares with about 130 crores same time last year.
Okay. Right. Thanks a lot for that. Just, a few seconds to go. Just want to point out that Lupin is one stock that has had it really good over the last many weeks and days. And this morning, JP Morgan has upgraded Lupin to an overweight with the target price raised to 2,400. So that's another stock to look at.
Absolutely. And I think should be reacting, as you said, stocks done very, very well going into those results and out of the results as well. So first rates coming up, the Nifty and the Sensex will do a quick check. IT index was the biggest loser. 24,373 is where the Nifty is starting and 79,800. So the Nifty is up 200 points and the Sensex is starting with a 700-point gain. So about 1% higher, both on the Nifty and the Sensex. Nifty IT is up 1.6, which means it's entirely reversing the losses from yesterday, almost entirely reversing. Nifty Bank was in the green yesterday, but barely so. It's up 0.5% at the word go, 50,417. Market breadth is positive, 4:1 in favor of what's up right out of the gates. So that is the overall picture as far as indices are concerned, but let's take it to stocks.
Absolutely. So let's take a look at some of the result reactions first up. For Eicher Motors, good set of numbers. Brokerages have raised their target price on the stock. So Eicher Motors is up 4% right now. Margins have improved, so the street likes that. Let's take a look at ONGC, because over there, Morgan Stanley has raised their target price on ONGC to 430. You know, that one has, of course, been gaining all this while, but ONGC just pulled that up for you. Cochin Shipyard is also up almost about 6%, so result reactions coming in over there. And then you have Biocon, where the earnings were weak. The margins are down almost 290 basis points year on year, so Biocon could be in the red this morning. Lupin, as I was talking about, JP Morgan has upgraded into an overweight, raised its target price to 2,400 on Lupin. So, you know, that one perhaps could look good. But for now, Eicher Motors and ONGC are your top gainers. Both are up about 3 to 4%. And then you have all the IT names, HCL Tech, Tech Mahindra, Infosys, TCS, Wipro, all up in the green, up about 1 to 2%. M&M is holding up. So there's barely any stock in the red. BPCL, HDFC Life are two stocks that are just trending in the red. And for now, the market, look at that, looking extremely solid. Sensex up 800 points, Nifty up 230 points. We've bounced back, and how?
Well, that's right, Sonia. A few stocks, though, they're seeing big moves today. Bharat Rasayan, I saw that company on our ticker, the sharp jump in operating numbers. EBITDA is up close to around 6x. That one is up close to 10%. So one of the top movers in today's trading session. Keep an eye out on that one. Bharat Rasayan is the one they're talking about. JG Chemicals, that one as well is up close to around 10%. Bharat Rasayan is now up close to around 17%. JG Chemicals is up more than 10%. Those numbers as well look pretty good. So that one's flying away. Cosmo first, we'll try to get the management later on in the trading session, and that one as well has opened up with a gain of close to around 6%. On the flip side, Birla Corp, that one, the numbers we just explained to you were quite disappointing. Margins weak, realizations under pressure, stock down 3.5%. It's corrected from 1,800 to around 1,400 rupees, but that's under pressure. Shankara Bilcon is another one that's down more than 3% in today's trade. I guess those numbers as well were rather disappointing. Let's pull up SAIL. The initial tick was in the red, but the street was prepared for a net short number. So SAIL should come up in the screen. It's still down close to around 2%. The high debt in their books, that's what's swaying. Earlier today, we mentioned that maybe tech will do well and maybe metals will do well. For starters, since the global space is in a better position, you have the IT index that's up close to 2%, the metal index as well as up close to 100%. Both of them have pulled back this week. So that's why we're seeing these stocks doing quite well. Emphasis, Oracle, Persistent Systems, all of them up more than 2% in trade. It's a good start. Let's see how we end Friday for the start. It's to the books.
Absolutely. And, so we got about 240 points gains on the Nifty coming through at this stage. And the biggest volume-led gainer is Cochin Shipyard. Cochin Shipyard is up, 5.5% right now. 24.35 on Cochin Shipyard coming through. That's a sectoral sort of snapshot view. I think you've got equal number of sectors in the red and similar number of sectors in the green as well. So metals are lower, FMCG is down, infra is down, energy is down, real estate is down. And of course, autos, I think it's just a rebound because auto sector lost about 8-9%. While the Nifty lost about 4.5% in this recent fall. So there is a bit of a move up on the auto sector. It's up 1.25% this morning. So just to pull back. Otherwise, healthcare is up about 0.8, pharma is up about 1, and financials are up about 0.8% as well. So that's the overall landscape. Let's just tell you a few of these stocks. Cochin Shipyard is the biggest volume-led gainer. It'll come up on your screen. 24.18 on Cochin Shipyard. ONGC is up 3%. It's got very large volumes. Triveni Turbine was a very large mover yesterday. It's coming up with large volumes, 4% in the green. I think Nigel mentioned ITD, big move over the last 2 or 3 days now. 572 yesterday, of course, ITD was up, I think, 15%. K Fintech was a very large mover yesterday. That is essentially the mutual fund RTA. I think a competitor to CAMS, 970 on K Fintech after the move that we had. I mean, so basically, day before yesterday, the stock left off at 840. It's 970 this morning. 2 sessions. I mean, actually, a session and the first few minutes today. You have Oracle Financial Services, 3.5 higher. Emphasis. So yeah, IT is doing well. Mayur Uniquoters is another one. Interesting name there. It's up 6%. The recent low on Mayur Uniquoters was about 580. It's at about 666 this morning. There is Fact, which is up about 2.75%. Cosmo First, I think we mentioned. PC Jewelers. I go down the list, but volumes start to thin out a little bit. On the downside, there's not very much. I mean, I think Apollo Tyre, maybe 2% down. All these, the PSU names, RVNL, SAIL, IFCI, IRCON, BPCL, HPCL, MTNL. I mean, I think that's the only sort of common thread I can find, which is all of them are essentially PSU names, and they're all down between 1 and 3.5% this morning. Large volumes, of course, on most of these names. Gautam Dugar is with us. He's Head of Research and Institutional Equities at Motilal Oswal Financial Services. Gautam, good morning. Great to have you with us here. So the market, of course, when it sells off like it did on the back of global cues, is indiscriminate. Everything goes down. But then you start to emerge a little bit after the storm has passed and you find opportunities, right? Which could be meaningful because stocks sell off aggressively. So let me start by asking you, are you, maybe in a more tactical kind of a way, are there those kind of opportunities in your coverage universe where you think stocks got sold unnecessarily?
Good morning, Prashant. Thanks for having me. Prashant, I don't know if sold off is the right word to use because we are hardly down 600 points on Nifty, right? I think last week at the peak, you were 25,000. Now I think we are at somewhere about 24,300 or 400, that range. So less than 3-4% correction, actually. It's not even a correction. If you look at the mid-cap and small-cap indices also, they are down hardly 3 to 4%. The rest of the world markets have gone to levels where they were 1 year back. We haven't even traced back to 1 month old levels, right? The trailing 12-month mid-cap and small-cap indices are still up 50% each, more than 50 actually. And Nifty on a trailing 12-month basis is still up more than 24%. So we haven't actually seen any correction whatsoever yet. We I think discussed defense names, railway names last time when we interacted. Defense market cap, which has gone up from 1 lakh to 11 lakh crore in 3 years, has hardly fallen 10%. So we've not seen any correction, Prashant. And despite having a very muted result season, the market has been very charitable with most of the stocks, right? So this was expected to be a weak result season. It is a weak result season, but market has taken it in its own stride. So yeah, I mean, we have to see a lot more if there is any correction left.
Okay, well, for now, the market is definitely bouncing back. And it just goes to show that this has been an out-and-out buy on dips market, right, Gautam? I mean, every problem thrown at it, the market has sort of come out strong. So tell me, what do you do now in terms of the result season is almost behind us? What has been the biggest takeaway for you this result season? Anything that interests you where there is perhaps still a little more valuation and growth headroom?
So, Sonia, yes, there is a growth headroom. Valuation, I suspect there is not much valuation headroom left. Your mid-cap Nifty is trading at 33p, which is at a 60% premium to Nifty. I have not seen such levels of premium in the past. A small cap is at a 40% premium to Nifty. It usually trades at a 20% discount. So absolutely no headroom for mid and small cap indices. Nifty is the only index which is behaving relatively more reasonably, I would say. It is at about 20.5 times on a rolling forward 1 year basis. As far as result season is concerned, we have seen very flattish numbers for the 45 companies which Nifty, where we have seen numbers come through so far. Earnings growth is 4% versus expectation of 2%. And for our broader coverage universe, where 200 plus companies have reported, earnings are down about 1%. We were expecting 2% decline. So absolutely in line. Largely an impact of OMCs. Ex of OMC growth is 10%. Which is also in line with expectations. So it's been a mixed bag actually insofar as sectors are concerned. You've seen decent performance coming in once again from auto, which is beaten expectations. Capital goods is in line at about 20% growth. Pharma has been a standout performer for this earnings season. Earnings growth is 26% for our coverage universe, where 15 companies have reported so far. And metals have actually beaten expectations because of some solid outperformance from Coal India and Hindalco. On the downside, you had cement, you had spec-chem, you had retail, you had oil and gas, which have disappointed and missed expectation. And then there are biggies like financials and tech, where earnings have been in line. So net, we have seen about 1% of a cut for our FY25 and 26 estimates. We are now at 1120 and 1320 as far as EPS is concerned. So muted result season, unexpectedly so. From here, you will see earnings pick up a little bit, and we should end the full year at about 13-14% growth. And so far as sectors are concerned, we had recently upgraded tech and pharma. So there we remain quite constructive. Consumer staples, we had a hope that there will be something coming in budget, which has not come. But monsoon has been good. So maybe given the big underperformance that this space has seen over the last 3-4 years, at least relative risk reward is favorable on consumption side. And financials, while we'll continue to look relatively cheaper vis-a-vis other sectors, but stocks don't move because there is an overhang of deposit growth now. And best of the earnings, as far as financial is concerned, they've had a rocking 5 years from FY19 to FY24. Now growth is very healthy but moderating, and there are other headwinds emerging. Some of the NBFCs, we have seen asset quality stress emerging. So yeah, I mean, it's very little to choose within the relative context, and it will be good if market were to consolidate and time correct for some time and digest the gains that we've had over the last 18 months.
Sure. Gautam, just one follow-up, since we're talking about earnings, right? I wanted your thoughts on autos, because there's such a divergence over there. Some companies like Bharat Forge are de-risking and now, focusing more on the non-auto space, whether it's defense, whether it's aerospace. Clearly, there is a slowdown in the auto sector right now. So what do you do here? If you own auto stocks, do you sort of churn out? What's the best way to approach it?
Yeah, so absolutely. See, we have downgraded auto from overweight to underweight when we did our model portfolio revision at the time of preview about a month back. You have to look at the context for auto between FY21 to FY24, which is a 3-year period. Auto earnings have tripled from 18,000 to 62,000 crores. And I'm only talking about the nifty auto stocks where there are 6 companies. Now, FY25 and FY26, we are expecting a very tepid 10-12% kind of a growth in auto. So as far as this quarter is concerned, clearly they have outperformed expectations because of the big outperformance of Maruti and some of the other heavyweights. But incrementally, the growth is going to look much more moderate than what one has gotten used to over the last 3 years, which is one of the reasons why we downgraded. As far as our choice is concerned, we prefer M&M still. We have had no Maruti, no model portfolio for the last 3 years now, and we are comfortable holding M&M because tractor is also expected to revive now, given that we've had a good monsoon, plus their SUVs continue to do well, and valuations are still very reasonable in the context of overall market. And then in the two-wheeler, we think Hero can be a tactical bet around monsoon. Very little to choose, actually, Sonia. We got lucky. We had added Motherson Samvardhana, I think, in April. By July, the stock was of 75%. So we removed it, given that such a large cap stock has had such an outstanding performance in 3 months. So auto, incrementally, you would see a lot more consolidation happening because the base is getting very high now. And FY24, both on volumes and margins. So volume growth will also taper off, and margins will also look very range-bound now.
I got that. So with auto, let me sort of push that point ahead. With Ola Electric listing today, Gautam, I'm not asking you to tell us whether buy, sell. No, I'm just saying, how do you think about this? Pure play EV electric company. Market cap would be about $4 billion. I mean, at least what they sold the issue at. How do you think about this one?
No, it's going to be an interesting listing and very interesting choice for investors in the auto sector. See what is going to happen in auto over a period of time now in the next 2-3 years. You will see divergence of choices emerging. You have Ola now. At some point of time, Hyundai will come. So auto sector, which has not seen much of a listing action on the big names, you are seeing that happening after a long period of time. We had seen similar action happening in financials 3-4 years back when insurance and AMC companies started listing. Similarly, in consumption, you've seen an emergence of variety of categories over the last 5 years. So it offers an interesting choice. One has to be very patient with such kind of names because they're right now not profitable. Plus, there are some headwinds also emerging on the EV volumes. You've seen in the last 2 months, EV volumes tapering off. The support of subsidies slightly tapering away. So in that context, one has to see how the volume trajectory and penetration of overall electric vehicles emerge in India in the next 2-3 years. While the trajectory could be very strong over a period of time, the next 3 to 5 years, but near term 3-6 months, one will have to see how consumers adjust to the absence of subsidy. But yes, from a stock market point of view, it's a very interesting listing, and it offers a wide variety of choices for investors to choose from in an overall very solid sector.
You have explained a lot about the business, but you've not said whether one should buy it or not. So post-listing, I mean, should one buy? Should one wait for profitability or signs of, profitability? What should one do?
Won't be able to comment, Sonia. We don't have a coverage, and it's neither part of our model portfolio.
Okay, I understand. All right. Just before we let you go then, any thoughts on, you said that you're getting into the pharma space in a big way. And as we speak, a lot of pharma stocks are actually sitting at fresh highs. Ipca Labs is at a fresh high. Zydus Life, Lupin has done very well, up 2.5%. Ajanta Pharma is at a fresh high. Eris Life Sciences as well. So if someone's missed out on the rally here, is there still more to go? And do you stick to the large caps, or do you look at the non-index large caps in pharma?
So pharma, obviously, there is still more to go in my view, because the earnings are looking very solid. You've had a very good FY24. We're looking at a strong FY25 as well. And within pharma also, you have a variety of choices. You have US generics, you have domestics, you have healthcare in the form of hospitals and all. So we like both hospitals and US generics, and also some of the India-focused plays like Mankind. So we hold Mankind in our model portfolio. We like Sun Pharma. We like Max and Vedanta, both in the hospital space. I think this sector is going to see good outperformance in the quarters to come, because it's one of the few sectors where, if you look at the 8 quarters of earning trajectory, it's been very stable and very healthy. Very few sectors in India right now are offering that kind of consistency on earnings growth, not even consumer. So yeah, I mean, healthcare, I'll be very, very excited to continue to hold.
Gautam, you're talking about Max Health Pharma, or
hospitals, yeah.
Hospitals. No, so I have you look. Do you have coverage on Aster DM? I mean, there is this deal brewing. You don't have coverage with the Care Hospital. So it'll be the number 2 or the number 3 largest hospital player after this transaction goes through. But anyway, for another time.
Broad point on hospitals is that, given the way some of the hospital investments are happening, you're hearing news about Bajaj Group stepping into the hospital space. A lot of private equity players have been very active on the deal side on hospitals, both on the organic and inorganic side. So clearly, the consumption for branded healthcare services post-COVID has gone up, and which is what you're seeing in numbers. There has been a lot of hospitals, companies which have got listed in the last 2.5 years, and suddenly become very important and relevant piece within the overall healthcare allocation that if you look at 4-5 years back, the entire discussion around healthcare will stop at Sun, Reddy, Lupin, and Cipla. Today, you have about 30-35 companies which are investable.
Right, Gautam, thanks a lot for joining in. Wishing you a good day ahead, a good Friday. Already looking quite relaxed, set for the weekend, looks like. Appreciate you joining in and giving us your view on the whole host of sectors, as well as on the earnings that went by. But let's focus on the next company, Astral. That's a stock we're looking at. Mr. Sablani, the ED and CFO of the company, joins us on the show. Hi, Mr. Sablani. Good morning, and thanks a lot for speaking to us here on CNBC-TV18. Well, for the next few years, you're guiding for mid-teens growth, close to around 15%. First quarter, you've grown by close to around 8%. Is it on expected lines? And do you factor in a much stronger growth in the second half of the year to get to that 15% odd mark? And also give us, how do you see the revenue mix evolving? As of now, you're plumbing, that's 73% of the business, while 27% is paint and adhesives. How do you see this mix evolving, say, in the next 2 to 3 years?
So I think we have given the guidance of 15% volume, and again that we have delivered the 16% volume. So I think whatever we have guided, we are in line with what we have given the guidance to the street. Similarly, if you see the margin side also, we have given the broader range of 16 to 18% margin in our plumbing business and 14 to 16% in our adhesive business. So overall, the numbers were in line, except our overseas subsidiary UK, which was not able to deliver the growth as well as the margin. So that is where the challenge came in this quarter. Otherwise, I think most of the numbers are in line what we have projected and whatever we have given the guidance to the street.
Your sequentially, your margins have taken a hit because of price volatility. In terms of PVC prices, do you think that could continue to remain volatile for the next few quarters? And what's the outlook there?
So if you see in our industry, normally Q4 is always at the peak and the Q1 is always at the bottom. So this is basically, you can say, seasonality of the business. And that is not today, it is from last 10 years, it is the same trend. Q1 is always the low, where your top line will be low and your expenses will be high. So because of that, always the pressure on the EBITDA margin. But the moment you turn to the Q4, the volumes are very high in the Q4. So that always give you the better margin and the better top line. So sequentially, if you see, yes, you are right, absolutely, it will be low. But that is the nature of the industry. And we are working in that kind of thing since so many years.
All right, no, got that. So, and we'll remember that Q4 peak, Q1 usually bottom. For the full year, 15% revenue growth, you'd stick with that, Mr. Savlani?
Revenue depend on how the polymer is going to behave. Like in the month of June, polymer shoot up very fast. But unfortunately, it was not able to pass through the market. And we all were expecting that from July onward, we will pass on to the market. And then again, the polymer started falling very sharply in the month of July. So because of that, the pass-through, which was everyone was expecting to happen, but was not able to pass through. So I think it is very, very difficult to predict the value growth because it is going to be volatile. If the polymer again goes up, yes, definitely there will not be a challenge. And secondly, our peak quarters are yet to come. So in peak quarter, if we perform reasonably better, then I think Q1 little bit loss will not going to affect the overall number of the business. So we are confident.
So then let's talk about volume growth for both piping and adhesives. What should we expect for the full year 25?
So I think we have given the guidance of 15% plus. So right now we are 16 at first quarter end. So we will monitor the things, how the market is going to behave. Normally what happens that whenever the price rise take place, everybody rush for the inventory stocking by dealer, distributor. And whenever price fall, they destock the thing. So that is where volatility will be there. But on a full year basis, this number even out. So we are of the view that still we are maintaining our guidance of 15%. If any change will be there in the market, we will upgrade the guidance or we can downgrade the guidance depending on the first year half performance. Last year also we guided 15% volume growth. Then half yearly we revised the guidance to 20% volume. And ultimately we ended the year with 25% volume. So it is very difficult to say at this stage, but right now we are sticking to our 15% volume guidance.
All right, Mr. Savlani, so 15% volume growth, and on margins you said plumbing business will be 16 to 18% and adhesives will be that 14 to 16%. Is that correct?
Correct.
Got it. Okay, let's talk about a couple of new segments. How do you see the paint business scaling up? If you could give us a few numbers. And also your bathware business, very, very small right now, but it's doing close to 25 crores on a quarterly basis. For the year, do you have a number in mind?
So like coming to the first bathware we have said that we are targeting to double the revenue this year. And if you see the first quarter, we have delivered close to about 90% kind of growth. So we are in line what we have projected. But of course, the base is very low. On low base, if you are doubling the revenue, it's not that high also, looking to the opportunity available in the market. But yeah, we are very, very positive on the bathware and we are going on the track. Now, as far as the paint is concerned, I think in the last quarter of June, we have launched the paint in Gujarat and Gujarat and Karnataka for Astral paint. So I think that number will start flowing from the Q2 little bit. And from Q3 onward, we are expecting that we should be delivering the good number into the paint also.
Okay, all right. We'll leave it at that. Thanks a lot for joining in and speaking to us about your business, maintaining the guidance of an overall 15% volume growth in Astral there. We'll step into a quick break. On the other side of the break, Mayank Singhal, the Vice Chairman and Managing Director at PI Industries, will join in for their Q1 earnings. Stay tuned. Welcome back. Well, it's still looking really strong for the market. We're almost ready to hit a 1,000-point rally on the sensex. And the Nifty is back above 24,400. The good part is we haven't seen any volatility up until now. And there's so much buying in individual stocks. Autos are topping the charts this morning. Eicher Motors is your top gainer, up 4%. Tata Motors, M&M are all leading from the front. And then you have IT stocks as well. Apart from that, you have large, percentage gainers as well in the non-index space. So let's take a quick look at that. ITD Cementation is up almost 8% and it's been gaining a lot of ground actually. This week it's up about 11%. ITD Cementation is the one I'm talking about. Just Dial, Cera Sanitary Ware, just look at that, 20% up move in just a week and it's up almost 40% for the year. A fresh high on Cera Sanitary Ware. The market cap almost now at 15,000 crores. So, these are some of these companies that are benefiting from this move from unorganized to the organized sector in this home building, etc., this theme. Affle India is also doing pretty well this morning, up almost about 4%. And real estate continues to, power through. Macrotech Developers is the one that's up almost 4% this morning.
All right, let's get to the next company then. PI Industries reported a good set of numbers. We have with us the company's Vice Chairman and MD, Mr. Mayank Singhal, who joins us on the show. Hi, Mr. Singhal. Good morning and thanks a lot for joining in. Well, congrats on a good showing. You're growing while most of the industry has been degrowing in the last couple of years. Now you're guiding for a 15% revenue growth. Could you break it up for us? What is the growth you're factoring in your mainstay CSM business, which has grown quite well? Also, your domestic market, well, it degrew for the past quarter at least, but monsoons have picked up. So split it up for us, this 15% growth that you're talking about between both these two segments.
Yeah, hi, morning. When I look at the situation today, yes, the global agchem market is a bit challenged, but there are green shoots which are coming out indicating the growth specifically in the innovator space where we belong. Clearly, these growths are coming from both the engines, while in the first quarter is usually the placement time and the seasons got delayed. But as you rightly said, for the domestic business, with the rains and I hope with no more climatical disorders, but we see a positive growth coming from the domestic business. At the same time, the CSM business is also showing us the growth rate. So I would say they're equally balanced between the two engines.
Okay. All right. But, don't you want to up that guidance of around that 15%? Because both the segments are going to fire. CSM has been doing phenomenally well and domestic recovers. Are you being a little bit cautious on that 15% mark? And also margins for the past quarter, was there any kind of one-off in it? And what should the margin band be from here on?
Well, let's be honest, what we've indicated earlier, the margin still stays to that. I think quarter on quarter would be the wrong way to look at it because there are different product mixes, different approaches, and obviously as we are scaling up, the operating leverage is also coming in. So what is the initially indicated margins will continue. On a quarter-to-quarter basis, they could vary depending on the product mix, market mix, yeah?
So 15% growth and 26% margins, is that correct?
Yeah, that's what we would now.
Mayank, we come back to that sort of blockbuster product, very important product, pyroxasulfone. And here, I believe that, and we reported this earlier, Kumai has received favorable rulings over process patent protection in Australia and China, which reduces the chances of competing products. So in a way, good for you. Could you contextualize this? How would you view this? You've always, of course, maintained that even if some of the competition does come through, it doesn't impact you that much. But this at the margin should be viewed as positive?
Well, as I said, this would be wrong for me to comment. It's a Kumai product and Kumai strategy. And obviously you can appreciate that being in the IP space, these are tactful moves and tactical approaches. So it will not be fair for me to comment. But clearly, yes, we are in the back end of the manufacturing space. Product continues to grow. The brand markets for these products are strong. Kumai has been heavily investing to grow business and creating differentiated strategies. So as I see in the mid to long, not much impact for PI.
Okay. You are one of the two suppliers to FMC for fluindapyr. The sales for this fungicide is expected to increase 10 times over the next 5 years. I just want to understand how big is this as an opportunity for you?
Well, I would not get into product-specific discussions here, sorry, because, we are in the contract manufacturing business, and I don't know whether the 10 or 5 where it's coming from because we are tied by confidentiality, being in the space and I hope you appreciate that. But yes, the new products are there. It is a good product which is performing for them. Obviously, based on that being a strategic supplier, we will definitely see how that shapes up for us.
But is this a very big opportunity for you in the sense, would this reduce your dependency on pyroxasulfone?
I would not answer that to one product. I think overall, if you see, PI has got a bunch of new products which have been coming into our fold for manufacturing over the last 4 or 5 years. And there are further new products coming into the fold. So obviously, maybe over the next 2 to 3 years, you will see the change of this pie shape in a very different manner. Already in the first quarter, growth has come from new products, which is 20%.
Okay, all right. So talking about how the pie is going to shape up, let's talk about the pharma business. The first quarter was subdued for a whole host of factors. How do you see the pharma business ramp up from here on? It did only 25 crores in the first quarter. So what should you end this year with? And also the newly acquired entity, PHC. You've been bullish on the prospects. The street believes that it's going to grow big time as well. Last year, I think it did close to around $11 million. What is the target year on, say in the next 2 to 3 years at least?
Okay, I think there are two questions there. Looking at the pharma business, clearly, as you know, we have acquired these various assets with various capabilities. Further to that, we've been augmenting and also adding to these assets to grow the technical capabilities and also building the regulatory framework around them. The objective here is again to play a differentiated game. Clearly, the current revenues which are there in the system will continue, but the long-term differentiated approach will be seen in the next couple of years as we continue to build on our capabilities and move into the different direction of the differentiated business offerings that we'll be doing in the pharma assets. So if I was to answer, I would very clearly say that PI is pretty satisfied with what's happened so far, and I'm pretty confident by the end of the year, we will be in a position to be really moving up in our strategy.
Okay. And on the acquired asset, you want to tell us that? PHC?
Yes, PHC, I think, is still in the process of acquisition. We have actually, there's an interesting asset, there's an interesting biological asset, which has distribution setups in the US, Mexico, and Brazil, and also in Europe. There's a unique platform of peptides, which is now, which we do believe is coming into shape with some products which are showing good performance and indicators in some of these markets. We are acquiring this platform of peptides, which I hope we will be able to, over again, a period of time, develop new products in the biological space and create a differentiator. And further, with these capabilities and reaches, we will be able to add more biological solutions and really answer our purpose of reimagining a healthy planet.
All right, you're avoiding any numbers there, Mayank. But final question before we let you go. As you've mentioned numerous times, there are various assets that you've acquired in the last few years. You're sitting on cash of a couple of 1,000 crores as well. More acquisitions in the pipeline?
So just to give you, I'm avoiding the numbers, not really, because the numbers are not significant to the bigger picture of PI on one hand.
Okay.
So I'll get that very straight. On the other one, yes, we are sitting with about 4,500 odd crores of free cash in the balance sheet. Right. Clearly, the company has always looked at the right way of investing money, which is a value accretive rather than scale and size. So we're looking for smart moves. And obviously, we continue to evaluate opportunities as we go ahead.
Okay. Mayank, we'll let you go on that note. Thanks a lot for joining in and all the best for the quarters to come. That's PI Industries. Revenue growth of 15% is what they're going to stick to for the full year. And Q1 was very strong for them, and hence the stock is up about 2.5%. Let's focus on Bharat Forge now. The company reported a good set of numbers. The defense revenue has surged 147%. Margins have expanded and the management expects continued positive momentum in Q2. Baba Kalyani, the Chairman and Managing Director of Bharat Forge, joins us now on the phone line. Dr. Kalyani, good morning and thank you for joining us and taking the time out to speak to CNBC-TV18. I want to first start with the non-auto. Good morning, sir. The non-auto business, right? Defense has been a big growth driver for you. It currently represents about 16% of your top line. Just trying to understand how much can this contribution go up by over the next, say, 1 to 2 years? And out of this order book of 5,400 crores in the defense vertical, how much will you be executing over the next 1 to 2 years?
You see, last year we executed roughly about 1,200, 1,300 crores, something like that. That was our first year of our defense business in terms of execution, large execution. This year we should be roughly about 2,200, something like that. And a large part of this defense business that we have and the order book that we have is all exports. And, that's the unique part of our defense business. The reason for that is all the products are designed and developed by us with our own IP, which is very unique in the whole industry in this country. The domestic defense business will hopefully start towards the end of the year when a couple of large contracts will get negotiated and finalized. So we see a continued momentum in the defense business. We have more than 30 to 40 products that we are going to launch, or let's say in the process of launching. So we are very confident about it.
Okay, so you're saying you have more than 30 to 40 products that are in the process of launching, and you will execute 2,200 crores of defense orders this year, which is in FY25. So currently your defense revenues, right? You're sitting on around 650 crores of defense revenues. What is the kind of growth, realistic quarterly growth that we can expect in the defense top line?
Yeah, in the defense business, it's very difficult to give you a quarterly growth because it's a bulky business. You get an order and then you finish it. By the time you get the next contract, it takes a little time. But if you take it over a period of, let's say, 3 years, I think one should expect at least doubling of the defense business.
So, Mr. Kalyani, in 3 years, doubling of defense revenues.
Yes.
So FY28, basically?
Yes, I think one should look at if you are a good defense company, you should, in the current environment, be able to double your defense revenues at least in the next 3 years. So if you are going to do 2,000 crores now, we should be able to do 4,000 in FY28.
Okay, got it. And of course, defense spending around the world is at an all-time high. So point taken, sir. And this would overall, I mean, would India business, the domestic business, by that time be a significant portion? I mean, you spoke about some of those large orders coming through by the end of this year.
We are currently on 4 or 5 major programs which are under finalization by the Ministry of Defense. Hopefully, they will get finalized towards the end of the year, and we would see execution of that in, let's say, beginning of next year.
Hi, Mr. Kalyani. Good morning, and thanks a lot for speaking to us here on CNBC-TV18. The board has taken approval of 2,000 crores of fundraise. By when do you raise this money? And for what do you require this money? I mean, is there some inorganic plan that you have in the past? A couple of those government assets is what you're looking at. Has there been any progress? And is this fundraise for that?
Largely, we want to expand our Indian manufacturing. That is the whole idea of the fundraise. We believe there is a huge opportunity to increase Indian manufacturing. So we want to increase our manufacturing footprint in different states in India. There's a lot of opportunity. There's a lot of growth potential within the country, and a lot of, let's say, business that will come from places like Europe and North America into India. So we need to create much more capacity, and a lot of this is in different kind of products. You know, Bharat Forge was known as a forging company for many years, for almost, let's say, 40, 50 years. You know, today we have 5 different verticals. And clearly, we have developed multiple technologies to execute businesses in this vertical. Now, this allows us to create far more opportunities going forward.
So by when do you raise this money, sir? And is there a possibility that BEML, a stake, are you still interested in it? Has there been any move? We've asked you quite a few times, but has there been any movement there?
No, not yet.
And by when do you raise this money, 2,000 crores?
I think, we have taken an approval of the board to raise money. We now need to figure out how to raise it, in what form to raise it. But hopefully in the next few months, we will do it.
Okay.
We don't have so much need for money right now. We have almost 2,500, 3,000 crores on our balance sheet.
So you'd safe to assume you'll do it, I mean, opportunistically, when you need it, when you see something fructifying.
Exactly. We are working on multiple, let's say, manufacturing footprints to be developed within India, because we want to grow our Indian manufacturing, grow it, multiple times of what we are in the next 7-8 years.
Dr. Kalyani, I must say that it is really commendable. I mean, you were talking about how you started off 30, 40 years back as a forging company, and then you transitioned so seamlessly into some of these fast-growing sectors, whether it's aerospace, whether it's defense. So hats off to you for that. But I want to talk a little bit about the traditional business, right? Because there is a clear slowdown. I mean, I was looking at your own numbers as well. In the CV business, the revenues have been under a bit of pressure. In fact, there's a loss of market share as well in the CV business. What's happening in the industry now, and do you think it could get worse before it gets better?
First of all, we are only gaining market share in the CV business worldwide, including India. Okay? Yes, the CV business by itself is a little slow because of all the headwinds that you see in Europe and beginning to see in the United States. But overall, I think next 2 years, the CV business will bounce back because that is when the emission change will happen and there'll be a lot of pre-buy. So we expect next year and year after next to be a boom year in this business and with higher market shares.
Okay, so you're saying that right now it's a bit slow because of headwinds in Europe and even the US, but next year will be better. Your overseas subsidies, since we're talking about Europe and the US, your overseas subsidies made an EBITDA profit this time of around 90 crores. I think that was because of what we've seen, in terms of a recovery in Europe. Can we expect the subsidies to be profitable by the end of the year, by the end of FY25? And, what could be the trajectory?
I think you will see the subsidies to be profitable next year. Okay. We will continue to make progress, so you will see continued progress quarter on quarter on these subsidies. It's a difficult business that we are dealing with. It's a highly technology-oriented business. It's not just pure metal forming. It's aluminum components made for the electric and hybrid vehicle that are produced in Europe and the US. But we are very confident that by the end of next year, we will have these businesses running profitably.
Okay, so overseas subsidies will be profitable annually by the end of next year. Got that. That's important. And, just before we let you go, once again, coming back to the new verticals, right? Defense, aerospace, it's now contributing a larger chunk to your business than a couple of years ago. What is the plan? How much will non-auto contribute compared to auto, say, over the next 3 to 5 years?
See, we have now 5 divisions in our company. We have our component division, which is the old forging company, which is what you described, CV and Pascar and all those kind of things. We have an industrial division, which is a new division where we now have 3 foundries in Coimbatore. And this is currently, the foundries are about at the level of 600 odd crores. And then we have an industrial forging business, which is about a little more than 1,000 crores. So we expect that this whole industrial business will double itself in the next 3 years. So we see a lot of traction happening in this business. So we have a lot of opportunities. We have opportunities in defense. We have opportunities in the industrial. We have opportunities in our existing component business. And as a combination of all this business, we are developing, electronics is very central to defense. It is very central to electric mobility. So, we are also developing that capability. Hopefully, in the next few years, you will see something happening out of that.
All right, Dr. Kalyani, thank you so much for joining us. Appreciate your time here on CNBC-TV18 and have a great weekend. By the way, that is Bhavish Agarwal, all set for the Ola Electric listing. Remember, it is India's largest EV two-wheeler manufacturer that will be hitting Dalal Street. It is also the first ever Indian EV two-wheeler to list on the exchanges, and this entire industry, right, the electric two-wheeler industry is expected to grow at a compounded rate of 11% over the next couple of years. It's expected to reach a size of $35 to $45 billion. So this is a big listing that we're just about to see in a while from now. Big day for Bhavish Agarwal and the entire team at Ola Electric. So let's try and get the first stick on your screen. It is Ola Electric is pretty much harnessing India's EV revolution, right? It is the market leader, and there you have it, 2.5% higher. So decent listing there. Volumes also picking up at 77.7. That is a 2.5% gain. There are, of course, some issues that Ola Electric has been facing. It is loss-making for the last 3 years. It reported a loss of almost 1,600 crores in FY24. And, there are, of course, other issues that the company is facing in terms of operations, etc. But if you look at the overall industry, it is a fast-growing, high-interest industry, and Ola Electric is the market leader over there. It's sitting on about 46% market share as of June 2024, and the second player is far behind. I mean, TVS Motor is the second largest player with 17% market share. So if this industry grows, then Ola Electric grows with it. But of course, it comes with its own fair share of problems.
Listings always are fascinating, right?
Yeah.
I mean, because, you've got a private business and suddenly one day you've got a quote which tells you, what the business is worth. I mean, it's just, not Ola specific, but I mean,
and it's an emotional time as well for, these founders. Yeah.
Absolutely. And, it's so a 76 rupees listing. So a listing basically at the issue price. Now moving up a little bit, about 4% higher, 3 rupees. That's about 79 on Ola Electric. Look at the volumes, of course. It's a household name in that sense, right? And it's now part of the public market. So expect a lot of activity around this as we go along. So these are the first rates and the first moments, the first pictures which are coming in. Bhavish Aggarwal there and some of the top Ola management team. A congratulatory mood, walking down steps after ringing the bell. And we'll have, of course, we'll be playing out our sort of excerpts out of that interview with Bhavish as we will through the course of the day. But first rates on your screen at about 79-ish right now.
Also, this is one sector, right? Electric two-wheelers, which is highly underpenetrated.
Yeah.
Only 5% of the two-wheeler market comes from EVs.
Yeah.
So the scope of growth is immense over the next many years.
Yeah.
Of course, Ola is facing its own challenges in terms of losses, etc. But, the widening of this industry is something that the street is perhaps betting on.
I mean, there is no doubt, right? I mean, there's a long runway of growth. But it's just, you got to who's going to come out on top, because you got your Bajajes and you got TVSs and all of them, of course, lining up products, big launches, etc. But Ola's got the first mover advantage. Although Bhavish told me earlier that, well, I'm not the first mover.
No.
I looked at TVS and others who had already come to the market and learned from their mistakes, and then I launched my products. But at scale, he's got the first mover advantage.
And he's a pure play EV maker, right? I mean, the others have the IC engines, etc. So
I think there is a little more traction now coming through, right? 5.5% higher on Ola, at about 80-ish at this point. So it's not a bad listing for, of course, I mean, $4 billion plus market cap company. One of the larger, of course, larger of the companies which has come to the market in the recent past. Prakash Diwan, I think, is with us. Maybe we can go across to him for a quick word. Prakash, how would you look at the listing and what from here?
Good morning, Prashant. So I think the listing is definitely far better than what personally I had anticipated. There was a little bit of that softness that was expected given the large float and the response that it got in the IPO. But, I do agree this is going to be a bellwether name in that sense. For anybody who wants to have an allocation directly into the EV space, I don't think there's any better bet than this in terms of composition. But remember, it's just about a few percentages of the overall two-wheeler market. As Sonia said, 5%. I thought my number was about 3.5%, and out of which they have a lion's share. So it's still a very small, percentage in terms of the overall scheme of things. But as you rightly said, EV is likely to be here. By the way, China has got 51% new vehicle registrations come from EVs last month. So that's the kind of change we are moving towards, hopefully. So great name, good setup, everything's fine, but very, very difficult to kind of sustain growth at these rates in this business. So I would like to look at this once it turns profitable. And there's still a long way to go for that. So, wait for that, because we've done that mistake in some of these new age companies as well. This is not new age in that sense, but in terms of behavior, it could be very similar to all the Zomatos and Paytms and Nykas and deliveries of the world.
In this space, how are you feeling about the, Ola versus the other players? Because, I mean, it's not an apples to apples comparison because the others have IC engines as well, TVS and Bajaj. But they're picking up too. Bajaj Chetak has been doing pretty well. TVS, of course, as we know, has, cracked the code in this electric space. So if you had to choose, what would your pecking order look like now?
So, Sonia, that's a very valid question. Just because Ola has got listed doesn't mean that you need to kind of load up. TVS Motors has been probably the most balanced in terms of when it comes to ICE and EVs. And remember, all of them, whether it's TVS, whether it's Ather through Hero through Ather, or whether it's Bajaj, they have a huge distribution setup, which is going to be extremely difficult for Ola to compete with. Right now, the novelty value is superseded anything else. But at some point in time, I think TVS and Bajaj will also start scoring very well on the EV. So as Bhavik said, they've learned from the mistakes that TVS made. Somebody else will learn from Ola's mistakes as well, right? So this is an evolution which is fairly evident and rapid. I would believe TVS would probably be far better placed in that sense from a more equilibrium balanced kind of allocation rather than Ola. This is probably fancy on the listing side, so there will be some takers who want it, but I don't know how long this sustains.
Okay, thanks a lot for that. So that's Ola Electric, decent listing there, 6% higher now on the stock at 80 rupees currently. You will of course keep hearing more about this listing over the course of the next few days, but the debutant Ola Electric now 6% higher. Let's slip into a quick break. On the other side, we'll get you a lot of stock related news. Stay tuned. Welcome back. Well, for now, let's focus on some stocks around the move. ABB is the one we're looking at. Vamakshi is here with more on that. Vamakshi, over to you.
Well, this stock is surely surging on the back of a good set of numbers. Revenue came in nearly, saw an uptick of almost 13%. It was a miss as far as the polls are concerned by almost 8%. And it is the motion, electrification and process automation business that is driving this growth. Robotics and discrete automation, however, saw a nearly 31% dip as far as the revenues are concerned. But the margins are the ones to watch out for this time around. And that is because the margins continue to be at a record high for the company. EBITDA margins have expanded by almost 526 basis points and have come in nearly 225 basis points higher as compared to our poll. Positive price movement, cost optimization and steady material costs supported this improvement. When we look at the segment-wise margins as well, we're seeing an improvement across the board, and this improvement is largely being led by the motion business followed by electrification. EBITDA resultantly came in nearly 56% higher, 4% higher as compared to the poll, and the net profit was up nearly 50%, nearly 3% higher as compared to the poll. The ordering activity, however, was a bit subdued. Order inflow dipped by around 5% and order backlog growth was rather muted at around 7%. The company also announced plans for capex. They will be expanding process automation as well as the electrification businesses. They've already secured a land on lease of almost 6.41 acres and they will be making an investment of up to 85 crores. So overall, good numbers coming in from ABB. They're expanding their capacity, bodes well for the company. As a result, the stock is trading higher today.
Okay, well, thanks a lot for that. The stock to watch right now is the new listing. Ola is up 11%. So big move coming in over there. Remember, the valuations were also brought down for Ola Electric. So there was quite a bit of pessimism on the stock. In that sense, there's a bit of a relief that you're seeing right now. 9% higher on Ola Electric as we speak, 83 rupees on that one. So decent listing coming in there for India's largest electric two-wheeler manufacturer that has now hit Dalal Street. But let's slip into a quick break. On the other side, Lata will be joined by Sridhar Shivram, Investment Director at Enam Holdings, to discuss Q1 earnings and the market outlook post the monetary policy decision. Stay tuned.